Well, let's take a look at his mutual fund investments, Narendra. They have the IDFC Premier Equity, DSP BlackRock Top 100, SBI Emerging Business, and iProve Focus Blue Chip Fund. These are all excellent funds, and they've obviously been recommended by you at some point during the show. Now, he has another question, apart from the fact that are these the funds that suit him? He says the expense ratio is very high on these funds. He wants to know, will it be more efficient if he were to switch to the direct option in these funds? And what sort of a tax implication will that have, Narendra? Because if he switches, that will effectively mean pulling out the money from one fund and putting it in another. That will involve some sort of charges, won't it?
Yes, it will, but he can plan it efficiently. One is that exit load will be levied if his investments are less than 1 year old. Only that part of the investment which is less than 1 year old. So maybe he should, retain the money in these funds, and incremental money can start moving into the direct plan. And as and when these investments get more than 1 year old, then that money can move into the direct plan. He can redeem and put that money into direct plan without any tax implication. Direct plans will be 1% cheaper, and it will be quite meaningful given his time frame.
Very quickly, what's your view on his fund selection? Can he continue investing in those funds?
He has chosen good funds, but these funds are not necessarily the appropriate funds for his goals, because I generally dislike funds with narrow objective, and all his funds are not narrow in that sense, but two of his funds are large caps and two of his funds are mid caps. Of course, the IDFC Premier Equity is not a mid cap fund by design, but it happens to be a mid cap for a while. But emerging business generally is also has been a mid cap fund. So my suggestion will be, why not track our aggressive growth portfolio without the fixed income allocation, because your fixed income allocation is taken care of with your emergency fund as well as your EPF contribution. So without that component, if you replicate our aggressive portfolio, that will be a more desirable thing. And if you are replicating our aggressive portfolio, two of these four funds can be retained, which is IDFC, Premier Equity, and SBI Emerging Business.